Dear Chairman and members of the Union of Arab Banks, esteemed guests, I respectfully greet you all. Welcome to Istanbul. Sabahul Khair, marhaban bikum fi Istanbul. I would like to thank the Chairman of the Union of Arab Banks, Mr. Mohammed Al-Atrabi, and the Union's senior management for organizing this meeting in Istanbul this year. I'm honored to have this opportunity to speak to you all. I will start by recapping the current global economic outlook. Then I'll share some of my views on monetary policy in Turkey and its effects on the banking sector. I'll conclude with a few remarks on participation banking and recent advances in financial technologies. Distinguished guests, we are at the peak of the global tightening cycle. Inflation has come down throughout 2023, but it remains above the targets of central banks. Growth slowed in response to tight financial conditions. In addition, geopolitical tensions increase inflation risks by raising short-term volatility in energy and commodity prices. Geopolitical tensions further create risks to long-term growth prospects due to the ongoing trend towards economic fragmentation. A decade ago, a tightening in financial conditions in advanced economies, the likes of which we have seen recently, would have had significant spillovers to emerging markets. However, owing largely to improvements in monetary policy making, central banks in emerging markets have become far more able in alleviating global risks. First, more and more central banks are doing explicit inflation targeting. As such, they tightened policy significantly in response to rising inflation in the aftermath of the pandemic. Second, improvements in the global financial architecture and domestic policy frameworks led to lower exposure to volatility in capital flows. Let me give one concrete example of such an improvement. According to a recent OECD report, the share of foreign currency denominated debt issuance by emerging market treasuries fell from 15% in 2005 to just 4% in 2022. This does not mean that we're done in terms of improving the resilience of financial markets and emerging economies. For example, the use of local currencies in bilateral trade remains limited. Increasing this would further raise the resilience of domestic economies to global shocks. Therefore, given the interconnectedness of our economies and financial sectors, we need to continue to improve our regional cooperation. I was in Qatar last week for the Qatar Economic Forum, and the discussions there also focused on where we can improve cooperation. I also believe that the Istanbul Financial Center will become a regional center and help enhance cooperation in financial technologies and architectures. Distinguished guests, as you know, the situation in Turkey diverges from the global outlook, with inflation as the overarching issue. The latest April reading was 69.8%, and we expect inflation to reach around 75% in May due to base effects. To reestablish price stability, we began a tightening cycle last June and have already seen significant improvements in the current account balance, in our FX position, some signs of moderation in domestic demand, and an increasing preference for Turkish lira financial assets. We expect to see a sustained decline in headline inflation starting in June. This decline will in part be due to base effects during the summer months, but will also be sustained through the continuing improvement in the underlying trend of monthly inflation. Our yearly inflation forecasts, which also serve as interim targets around which we calibrate our monetary policy, are 38% for the end of this year, 14% for 2025, and 9% for 2026. Going forward, we will need to maintain a tight monetary policy stance until a significant and sustained decline in the underlying trend of monthly inflation is observed, and inflation expectations converge to our forecast range. Monetary policy stance will be tightened in case of a significant and persistent deterioration in the inflation outlook. Our firm monetary policy stance will bring down the underlying trend of monthly inflation on the back of rebalancing domestic demand, the real appreciation of the Turkish lira, and the improvement in inflation expectations. Esteemed participants, we know that monetary tightening cycles bring challenges to the financial sector due to the subsequent slowdown in real economic activity, and rising uncertainty over banks' asset quality. However, the banking sector will be among the main beneficiaries of the disinflation in Turkey, as both the households and corporates have very low levels of debt, both based on cross-country comparisons and historical data. As price stability is established and confidence in the Turkish lira increases, the low level of debt means there's a significant room for the banking sector to grow. In our case, the complex set of micro and macroprudential policies that we have been gradually simplifying further place the burden on the banking sector in managing their balance sheets. Fortunately, one of our biggest advantages is the resilience of the Turkish banking sector and the agility with which our banks manage their assets and liabilities. This resilience dates back to the 2001 crisis and was strengthened in the period after the global financial crisis. Turkish banks have since increased the overall quality and quantity of risk-based capital and begun to maintain ample liquidity and provision against balance sheet risks. We also have a complete and up-to-date set of banking regulations that are well in line with Basel III regulations. More traditional measures of banking sector resilience confirm the soundness of the financial system. The sector's capital adequacy ratio is strong and above the regulatory thresholds. Capital structure mostly consists of common equity Tier 1. As of March 2024, the banking sector's capital adequacy ratio is 17%, far above the 8% minimum limit in Basel regulations. The common equity Tier 1 is above 13%. The sector is also large with a healthy asset and liability structure. The asset size of the banking sector exceeded 25 trillion Turkish lira, approximately $804 billion, as of the end of March 2024. The share of loans in total assets is at 50%. Asset quality is high, and the non-performing loan ratio stands at historically lows, around 1.5% as of March 2024. The sector holds a deposit-denominated liability structure, meaning that its funding is relatively stable. As of March, total deposits accounted for 66% of total liabilities. While the share of FX and FX-protected deposit remains high, we are seeing a significant rise in the share of Turkish lira-denominated deposits.